William Lee is with us now, Chief Economist and Executive Director at the Milken Institute. William, good morning. Great to have you with us here. Prashant on the side. The Fed will come too, but Scott Bessent remarks to a television news network yesterday that we'll provide our trade partners with a number, which is the cost we estimate is the cost of doing business with you. How should we read it? It doesn't look like maybe it's big bang, but then there is room for negotiation. At least that's what I thought. What do you think, William?
It sounds to me like the Trump administration is opening salvo toward what they're trying to do by April, which is to try to establish a world trade framework where we can level the playing field. The notion of reciprocal tariffs does not mean that we're raising our tariffs. It means we're raising our tariffs up to where our counterparties, our trading partners, have their tariffs. So if between now and then our trading partners decide that market access to the United States consumer and United States marketplace is so important, they may actually lower their tariffs so that we will lower our tariffs. So right now, there's a tremendous amount of uncertainty because the state of play is in flux. And Chairman Powell today emphasized that over and over again. The uncertainty is where the level playing field will wind up after the opening rounds. And right now, I think Scott Bessent has given you the opening round for the United States.
Sure, absolutely. The opening round will be that number, and then let's see how those negotiations progress from there. William, thanks so much for joining us today. Now, I mean, what about the Fed's assessment? What do you think of it? Because at least yesterday, the Fed didn't seem as worried and concerned about recession, etc. In fact, the chairman alluded to some of those forecasts. He said that forecasts outside the Fed are pointing out to the higher probability of the recession, but we don't think so right now. What are you expecting in terms of further policy moves?
At the beginning of my professional life, I was a forecaster at the Fed. And I have to say, the state of art of forecasting really hasn't progressed much since then. And I think it's gotten worse because the media is starting to hype up a lot of the incoming data as if everything were the same. Soft data, hard data. And one of the things you learn as a forecaster is that soft data is exactly that. Very, very soft, very, very unreliable, especially confidence surveys. And that is where I think a lot of the press is getting its ammunition about, oh my God, the consumer is feeling awful about their state of life. Their confidence is down, and the retail sales have started to slow down. So clearly, we're on the verge of a recession. That conclusion is so incredibly absurd. I have a hard time understanding how professionals can stop from laughing. The consumer confidence surveys have always had several flaws about it. The Michigan survey is highly correlated with the stock market. When the stock market goes down, a lot of people in the Michigan survey respond badly. The Conference Board survey is highly correlated with the state of the job market, in particular, how easy it is to get jobs. And right now, there are a lot of job openings, but there are fewer and fewer hires. So there again, another explanation for why it is that consumer surveys have gone down. As Chair Powell said, it's really hard to tell what consumers say and correlate that to what they actually do. People say they feel awful, they think the world is coming apart, and they go out and buy a new car.
That's fantastic insight, William. And you've been a man on the inside, like you pointed out earlier in your career, so you would know. But then to sort of come back to that question, you don't seem too worried about the state of the U.S. economy in that case, just like the Fed. So what are we talking about over here? I mean, the economy chugs along, we get 2 cuts, and all remains well?
There is without a slowdown in the U.S. economy because it was growing at a very unsustainable pace, well above 2.5%. And coming down to closer to 2% is where the natural rate of growth is. And that's exactly where I and the rest of FOMC is anticipating the economy will glide into toward the end of this year. And the fact that the consumer is slowing down is a good thing because one of the huge vulnerabilities in the U.S. economy that's not covered enough, which I have mentioned on this show in the past, is that U.S. consumers are consuming as much as they are. In fact, they're consuming at a pace that's well above the pace of income growth because those consumers that have assets, that own stocks and pension assets, which is only about, by the way, 20% of the population, those consumers are accounting for 80% of the growth of consumption. And so long as they can cash in their capital gains, they're doing quite well. But as you noticed, the stock market has gone down, and those people with the risky portfolios shares in Nvidia, Tesla, and Magnificent Seven are not, feeling like they have that many capital gains to cash in anymore. So those consumers are clearly slowing down. The other 60% of the U.S. population has really been living paycheck to paycheck, hand to mouth. Many of them have had to get second and third jobs just to make ends meet. That was the basis of the huge amount of people voting for Trump, because they felt that they needed someone to change things around so that their ability to make a decent wage will get better. So the consumer slowing down is a good thing, is an expected thing, and is a very dangerous thing in the sense that it's something to watch out for, because once the people with assets run out of savings, that's when we start to run out of steam for the consumer. And the key is whether investment will pick up or not. And that depends upon the rest of the Trump policies, reducing the size of government, reducing corporate tax rates, encouraging foreign investments in the United States.
William, we'll leave it there. Great conversation as always. Thank you very much and look forward to our next one. Appreciate it here on CNBC-TV18. Well, there's some punchy comments coming in from William, and I think absolutely makes sense. One feeds off the other. Surveys feeds off the market feeds off the survey, so chicken and egg in that sense. But well,